I know you and I have a couple more questions we're going to ask here, and maybe I'll finish with one. But I've seen a couple dozen questions come in, and I think we should take some time to answer. So this one, because I believe it's important. If I'm an investor looking to deploy capital, what are some mistakes or misunderstandings that you often see when talking to somebody like myself that you just would want me to be prepared for, so that I don't make them, so that I can, actually close on this property and buy my STR?
I think the most common mistake I see is people that come in that aren't prepared, and then they enter into a contract, there's a deadline, and then they're getting stressed, and it's just not a good experience. And I think, how do you fix that? It's just by being prepared. It's about doing your due diligence, right? I think if you plan to make a transaction in the next 90 days, the first thing you're going to want to do is really do your research on Rabu, find the subject property, and pick one, and then contact a lender. And then when you contact them, say, hey, this is the property that I'm considering. I'd like to get pre-qualified for a DSCR loan before I put in an offer. So just being prepared for that before you put in the offer, having a lender look at your credit, have a lender review the subject property, essentially pre-underwrite that loan as compared to the terms available on a DSCR loan. So when you get in there, you're prepared to go. Now, if you're an investor, the other thing I see, which is common, if you're an investor coming in with the intention to close in an LLC, have all that paperwork buttoned up before you apply. I see a lot of people that come in, they found the property, they want to move, they get pre-approved, they intend on closing in an LLC, and they're chasing that whole process through the escrow. And then we're getting to the end, and then it just makes it very hard between title, escrow, lender to get all that information coordinated correctly if it's not there up front. So be prepared, have your asset statements ready to go, have your subject property information ready to go. And if it's an LLC, make sure that's in order.
Awesome stuff. Really appreciate this, Chris. Actually, one of the first questions we have on the list from the attendees is, it's a good segue. So what is the qualification process if you buy a property under a private business identity like an LLC? Do you look at business credit too?
No, we do not. We're looking at from the entity itself. We will allow for 4 members of that entity in order to do a DSCR loan. I guess in other words, it cannot be greater than 4. And we're looking at whoever the member, whether it's one or all 4 that are applying on the mortgage, we're going to look at the applicant's credit, not the business credit.
Got it. And again, just to confirm, as an LLC, you cannot get the Fannie Mae second home loan, right?
That's not close a Fannie Mae second home mortgage in an LLC.
Let's see. Yep. Makes sense. All right. One question here is, if someone is sitting on $500,000 right now, would you recommend someone utilize these DSCR loans to get into more properties, or buy one, paid off, and cash flow this? Obviously, this is might be more of an accountant, financial planner question, but anything you want to chime in there, Chris?
So the question is, if I have $500,000, do I finance a portion of it, or do I buy cash, right?
Correct. Yep.
I would not pay cash. I would finance, because that financing, at the end of the day, when you boil it down, through write-offs, taxes, and all that stuff, if you have a good CPA, and then you're holding on to that rest of that cash that you can deploy, that's going to earn for you, I think you're going to be able to reach a lot further. You invest that all into one asset, it's tied up in that one asset. Yes, you're cash flowing a lot better right out of the gate, but you're now on the sidelines on future investment strategies.
It makes sense. Next one, can you get lending on land?
You can get lending on land. That's not one that we offer. Typically land loans, smaller regionalized commercial banks, and then hard money lenders that are going to be close to the region that the land exists, right? Hard money lenders don't typically like to go out of state. There's very few that will. So when looking at a land loan, you're going to want to look for, either a hard money lender in your network or region, or look for a smaller privately owned commercial type bank.
Good stuff. This next one is good. It's a good one. What do you use to calculate the pro forma or the projection? Rabu, AirDNA, others have brought up. What do you guys use at theLender?
We're using Rabu.
Awesome. Always love that from our perspective. Next question. What fees does the lender have? The programs you're mentioning are available through majority of lending institutions. So I'm not sure is the case, especially on the short-term rental side. So the question is, what makes the lender stand out?
That's a great question. So let's understand where and how you get these non-QM loans, right? Non-QM loans, the vast majority of non-QM loans, DSCR bank statement type loans, are originated through broker networks, right? I'd say about 95% of them. There's very, very few outlets that lend non-QM that have a consumer direct division. theLender is one of them, and I think there's about 2 or 3 others that are out there. Now, when you go through a broker, the broker is going to charge a broker fee, a cost to you for them originating that loan and sending it to a company like mine, theLender. Now, as a consumer, what you can do is find these consumer direct outlets, right? Essentially skipping the broker, going directly to theLender and working with our consumer direct team. And the reason that it's going to pan out for you in the sense that we make our money as a lender by funding and selling these loans. Okay, a broker makes their money by originating fee for the service. Now, by coming to us, we're able to compress margins on the front end and the back end and pass through lesser cost up front and sell the same rate, the same terms that a broker will, but pass through lesser cost up front because we have 2 revenue streams and we can compress that. This is not a new strategy. You look at companies like Rocket Mortgage or Quicken Loans, they've been exercising this for years because when you call the company directly, there's a lot less cost in producing that loan, right? Therefore, they can pass it on to the consumer. When you work with a self-generating loan officer, whether it's retail or broker, they're bringing in the business, therefore they need to be compensated for that, so that it increases the fees. So by going consumer direct in some of these outlets for these products, it's going to save you money.
Love it. Makes all the sense in the world. Transparently, I'm not aware of many lenders that do provide short-term rental loans. So I think you guys definitely stand out for that. This is a quick one. Is there PMI for the 10% down Fannie loan?
Yes, there is.
Awesome. Basically, kind of the rule of thumb is anytime it's below 20, you should expect to pay PMI. Right.
That's correct. And in this, if you're looking at those products and you want to get rid of the mortgage insurance, again, if you can negotiate seller credit, you can use that seller credit to buy out the mortgage insurance up front. It's going to be probably anywhere from 2 to 3 points, depending on your credit score. But if you can get 2 to 3% from the seller and use that to buy out your MI, that's going to drop your monthly payment.